Warren Buffett has $300 billion in cash. And every financial commentator on the internet is asking the same question. Why? Is he bearish? Is he waiting for a crash? Is he just getting old and losing his edge? Wrong, wrong, and wrong. Because those are the lazy questions. Those are the questions that get clicks and generate hot takes and fill up 3-minute segments on CNBC. The right question, the one nobody is actually asking, is this: what does Buffett see that the rest of the market is choosing to ignore? Because here's what I know about Warren Buffett. He doesn't make $300 billion decisions based on vibes. He doesn't panic. He doesn't chase headlines. And he has spent the last 70 years being right about markets at the exact moments when everyone else was confidently wrong. So when the most disciplined capital allocator in the history of modern finance quietly moves to the largest cash position ever recorded at Berkshire Hathaway, larger than at any point before the 2008 financial crisis, larger than during COVID, larger than anything we have ever seen from this man. Maybe the question isn't whether he's losing his touch. Maybe the question is whether we're all about to find out exactly what he's been looking at. Let's start with the history, because this isn't the first time Buffett has done this. In 2004 and 2005, Buffett began complaining publicly that he couldn't find anything worth buying. Berkshire's cash pile grew, markets kept climbing. Commentators called him out of touch. They said he didn't understand the new economy. Then 2008 happened, and while everyone else was drowning, Buffett had the cash to deploy. He bought Goldman Sachs at crisis prices. He bought General Electric on terms that were almost embarrassingly favorable. He walked into the wreckage with a checkbook and came out billions richer. That's the Buffett playbook, and it has played out with remarkable consistency across multiple market cycles. In 1969, he liquidated his entire partnership because he couldn't find value anywhere. The market peaked shortly after and crashed hard through the early 1970s. In 1999, he refused to touch tech stocks, got publicly ridiculed. Dot-com bubble popped in 2000. Buffett was fine. The pattern is not subtle. When Buffett can't find value, he stops buying. When he stops buying, he accumulates cash. And when the cash pile gets to historic levels, history has a way of explaining why, usually about 18 months later. Right now, Berkshire's cash position is not just large. It is the largest it has ever been in absolute terms. And as a percentage of Berkshire's total assets, it is sitting at levels that historically precede significant market dislocations. That is not a coincidence. That is information. Now let me address the 3 explanations that financial media keeps recycling, because all 3 of them miss the point entirely. Wrong explanation 1. He can't find deals because Berkshire is too big. This is the most popular cop-out. The argument goes, Berkshire is so massive that it can only move the needle with enormous acquisitions, and there just aren't enough large deals available. There is a grain of truth here. Scale does limit options. But this explanation has been true for 15 years. Berkshire has been large for a long time. If size alone explained the cash pile, we would have seen this level of accumulation consistently for the past decade. We didn't. The cash pile accelerated specifically in the last 2 years. Something changed, and it wasn't Berkshire's size. Wrong explanation 2. He's holding cash for a specific acquisition target. Maybe Buffett has always said he's waiting for the elephant, the transformational deal. But $300 billion is not a war chest for one deal. That is a philosophical statement about current market conditions. You don't park $300 billion in treasury bills because you're eyeing one acquisition. You do it because you look at everything available and decide that cash, earning 5% risk-free, beats the risk-adjusted return on almost everything else currently priced in the market. Wrong explanation 3. He's just being cautious in his old age. This is the most condescending explanation, and also the least supported by evidence. Buffett's capital allocation decisions at Berkshire are not made by one tired old man. They involve one of the most sophisticated investment operations on the planet. And the moves Berkshire has made recently, selling Apple, selling Bank of America, reducing equity exposure broadly, are not the moves of a team that's lost confidence. They are the moves of a team that has looked at current prices and decided the math doesn't work. So what is the right question? The right question is, what does a 5% risk-free return on cash tell you about everything else? Because here is how Buffett thinks about this. Every investment decision is made relative to alternatives. When Treasury bills yield close to zero, like they did from 2010 to 2022, cash is a terrible place to sit. The opportunity cost of holding cash is enormous. You are almost forced into equities, into real estate, into something that beats 0%. But when Treasury bills yield 5%, the calculation changes completely. Suddenly, cash is not a drag. Cash is a legitimate return. And suddenly, the premium you need to justify taking on equity risk, the additional return above the risk-free rate that makes stocks worth owning, needs to be substantially higher. Now look at where stock valuations actually are. The S&P 500 is trading at roughly 28 to 30 times earnings. The historical average is closer to 16. That is not a small deviation. That is a market priced for perfection in an environment that is anything but perfect. Buffett looks at this and runs a simple mental model. If I can earn 5% guaranteed, what do I need to believe about corporate earnings growth to justify paying 30 times earnings for equities? The answer is a lot. You need to believe that earnings will grow faster than historical averages, that interest rates will fall significantly, and that no major economic disruption will occur over the next several years. Buffett is clearly not convinced, and when you look at the macro environment honestly, it is difficult to argue with him. Here is what I think he is actually looking at. 3 signals that mainstream financial media consistently underweights. Signal 1, the bond market. Long-term Treasury yields have remained stubbornly elevated, even as the Fed has begun cutting short-term rates. This is the steepening yield curve that Ray Dalio has been warning about. When long rates stay high while short rates fall, it signals that the bond market does not fully trust the fiscal picture. The United States is running over $1 trillion in annual deficits. Someone has to buy that debt. And as we have covered on this channel, the traditional buyers, Japan, China, are pulling back. When bond demand weakens, yields rise. And when yields rise, equity valuations compress. Buffett reads bond markets better than almost anyone alive. He is watching this signal carefully. Signal 2, credit conditions. Consumer credit card debt just hit record levels. Delinquency rates are creeping higher. The consumer has been the engine of this economy for 3 years, powered largely by Pandemic-era savings and easy credit. Those savings are gone. The credit is maxing out. When the consumer slows, corporate earnings slow. And when corporate earnings slow on a market priced at 30 times those earnings, the math gets ugly fast. Signal 3, the concentration problem. 7 companies represent over a third of the entire S&P 500. When Buffett looks at the index today, he is essentially being asked to make a massive concentrated bet on a handful of technology companies trading at historically extreme valuations. That is not how he has ever operated, and it is not a bet he is willing to make at current prices. Here is what I actually think is happening. Buffett is not predicting a crash. He is not timing the market. He is doing something far more disciplined than that. He is simply refusing to pay prices he cannot justify. And in an environment where almost everything is expensive, refusing to overpay means sitting in cash. The uncomfortable truth is that 5% on Treasury bills is a real return. And when you can earn a real return doing nothing, the burden of proof on every other investment becomes much higher. Most investors will not sit still long enough to let that logic play out. They will watch markets grind higher for another 6 months, feel the FOMO and chase. That is how these cycles always end. Buffett has seen this movie enough times to know how it ends. He just refuses to tell you when the credits roll. So here is the question I want to leave you with. If the most successful investor in history is choosing cash over everything currently available in this market, what does that say about what everything is currently priced at? Think about that before your next trade. If this video made you think differently about what Buffett is actually signaling, subscribe to MoneyNoteLab. Every week we cover the macro stories that mainstream financial media is too distracted to explain properly. We'll see you in the next one.